What is the cost of equity? The cost of equity is the return a company must provide to its shareholders to compensate them for the risk of investing in the business. It represents the minimum rate of return that equity investors expect for their investment. Unlike debt, where costs are explicit, e.g., interest rates, the cost of equity is theoretical and reflects the risk-reward trade-off for shareholders. Why does cost of equity matter for lawyers? Valuation in legal contexts. The cost of equity is a critical input in determining a company's valuation, especially in mergers, acquisitions, and shareholder disputes. It is used to discount future cash flows to their present value, helping to assess whether an investment or transaction is fair. Risk assessment. A higher cost of equity indicates that shareholders perceive greater risk in the company's operations or industry. This can influence legal strategies in cases involving corporate governance, securities litigation, or regulatory compliance. Capital structure decisions. Companies with a high cost of equity may prefer debt financing, as it could be cheaper. Lawyers advising on financing agreements or restructuring must understand how equity costs influence these decisions. Shareholder expectations. The cost of equity reflects what shareholders expect in return for their investment. Lawyers involved in shareholder agreements, disputes, or corporate governance must ensure that these expectations are aligned with the company's financial strategy. How is cost of equity calculated? The most common method to calculate the cost of equity is the capital asset pricing model, CAPM. Cost of equity, CU, equals risk-free rate plus beta times market return, risk-free rate. Risk-free rate, the return on a risk-free investment, such as government bonds. Beta, a measure of the company's stock volatility compared to the market. A higher beta indicates higher risk. Market return, the average return expected from the market as a whole. Legal implications of cost of equity. Contractual provisions. Shareholder agreements may include clauses tied to expected returns. Lawyers must ensure these provisions are realistic and aligned with the calculated cost of equity. Dispute resolution. In shareholder disputes, the cost of equity is often used to determine fair compensation or damages. Lawyers must be prepared to challenge or defend assumptions used in its calculation. Regulatory compliance. Securities regulations often require disclosures about expected returns and risks. Lawyers must ensure that these disclosures accurately reflect the cost of equity. Key takeaways for lawyers. Focus on assumptions. The cost of equity is based on assumptions about risk and return. Lawyers should scrutinize these assumptions in legal agreements and disputes. Understand the context, whether advising on a merger, financing, or shareholder dispute. Understanding the cost of equity helps lawyers provide better strategic advice. Ask the right questions. Even without performing calculations, lawyers can add value by questioning the inputs and methodology used to determine the cost of equity. By mastering the basics of cost of equity, lawyers can bridge the gap between financial theory and legal practice, ensuring their clients' interests are protected in complex financial transactions. Now let's practice what you learned in this lesson. First, multiple choice question. 1. What does the cost of equity represent? A. The amount a company pays in interest on its debts. B. The rate of return shareholders expect for their investment in the company. C. The total cost of all financing for a business. D. The tax rate applied to corporate profits. 2. Why is the cost of equity important in legal contexts? A. It helps calculate interest payments for loans. B. It determines the company's tax obligations. C. It's a key input for valuation, risk assessment, and shareholder disputes. D. It measures the company's legal compliance. 3. How is the cost of equity commonly calculated? A. Using the company's profit margin and expenses. B. By multiplying the corporate tax rate by the market return. C. With a capital asset pricing model, CAPM. D. By adding the cost of debt and preferred stock dividends. For what does a high cost of equity indicate? A. Shareholders see the company as low risk. B. The company pays high interest on its debts. C. Shareholders perceive the company as risky, requiring a higher return. D. The company has no debt financing.